So let's get into the differences between perpetual contracts and futures contracts. Perpetual contracts function similarly to basic futures contracts, but there is no expiration or settlement of perpetual contracts. And positions can remain open as long as the trader wants, as long as certain conditions are met, such as a minimum balance or a minimum margin level. More on perpetual contracts. The key concepts of perpetual contracts are the mark price. This is used to avoid market manipulations and to ensure that the perpetual contract is price matched to the spot price. It's often used to calculate unrealized profit and loss for traders. There's also the initial and maintenance margin. Initial margin is the amount of capital needed to open the position initially. And then the maintenance margin is the minimum amount the position must hold before the exchange asks you to either add more to the position or auto liquidation will occur. It's often advised to liquidate positions above the maintenance margin to avoid higher fees from auto liquidations. Once again, if your account balance, if the account balance does not maintain a certain threshold, depending on the agreement between you and the exchange, or you and the provider, the broker, they have the right to auto liquidate your position. The exchanges are not in business to lose money. So if your trade position goes against you, your contract, your position needs to maintain a certain level. If it's leveraged or it's in some sort of futures contract, it needs to maintain that certain level. Otherwise, the exchange has the right to cancel out your position and liquidate your funds. You also want to keep in mind the funding or the funding rate. Payments between all longs and shorts in the perpetuals futures market. Funding rate dictates which party is the payer and which is the payee. When we see positive rates, that means that more people are longing the market, more people are bullish on the market, and as a result, they have to pay a fee to people who are opening up short positions. Likewise, a negative rate means that shorts are paying long. There's more people shorting the market, there's more people bearish, and as a result, there's not enough people longing the market. And to incentivize balance, right, in these futures markets and perpetual futures, remember, every time that you open up a long, someone all has to be buying that, right? There's someone always on the other end of that position. So in order to incentivize balance, if there's overwhelming people longing the market, indicating an indication of a positive rate, the longs pay the short, and a negative rate means that there's an overwhelming people shorting the market, they will pay longs to incentivize people opening up long positions. We also want to consider higher risks. Now, unlike spot markets, futures markets enable traders to place large orders that are not fully covered by their collateral. This is also known as margin trading. They're using leverage or they're using margin. If the price goes against you in this particular situation and your maintenance margin falls below the threshold, the exchange can and will liquidate your position, as we spoke about before, and this will result in an instantaneous loss in capital and a closed position. Here's a bit more on funding rates. So funding rates are the payments made to either long or short traders. The rate is based on the difference between the perpetual contract price and the spot price. Funding rate is made up of two components, the interest rate and the premium. The interest rate is fixed at 0.01% per 8 hours. So every 8 hours this will shift. And the premium varies according to the price difference between the perpetual contract and the mark price. And this is something that may vary from exchange to exchange to platform. So be sure to look up and be well acquainted with your exchange's stipulations in regards to futures contracts before jumping into futures trading. Now, the funding rate is used to balance differences in prices between perpetual contracts and the actual price, where it acts as an incentive for traders to close long or open shorts when the rate is positive, and to close shorts or open longs when the rate is negative. Right? We're trying to maintain balance. That way there's an equal amount of buyers and sellers, an equal amount of longs and shorts. Now, these payments are made directly between traders, and exchanges do not collect the funding payments. They also incentivize balance in the futures market to ensure there is enough traders on both sides of the contract. For every person buying or long, there must be someone selling or short, and vice versa. Now, funding rates can be considered an indicator of market sentiment. If we're just generally doing a top-down analysis on where the market's going and what people are generally feeling the market will do, and sometimes that can be useful as a trading technique. Sometimes we want to see what the majority of people think. Sometimes it's useful to go with the majority, and sometimes it's useful to go against the majority, because sometimes the majority is wrong. In this particular case, in regards to funding rates, positive rates indicate that more people are long or bullish. They're expecting price to go up and they want to capitalize on that. Negative rates, on the other hand, this indicates more people are short. They're expecting price to go down and they want to capitalize on that. As a result, bullish markets will have a positive funding rate and typically will rise over time. Traders that are in long in a perpetual contract will pay a funding fee to traders on the short side. Bearish markets, on the other hand, will typically have negative funding rates that will lower over time. Traders in a short contract will pay funding fee to the long traders. Here's an example of Bitcoin funding rates history. This is actually from September 2021 going into March of 2022. And this is from coinglass.com. It's very useful derivatives analytics platform, similar to CoinMarketCap, but with a greater focus on funding rates and specific things for derivatives and futures contracts and information regarding that. Here we see generally in yellow here, we see this is the actual price of Bitcoin, tumultuous, and we can see these different colored bars are representative of each of these different exchanges: BitMEX, Binance, Bybit, OKX, Huobi, Gate, FTX, and more. Now, on the left side, we see our y-axis in regards to the funding rate. So anything above this zero level, the 0% level, is considered a positive funding rate, an indication that the market is looking to capitalize on the price growth, right? The market is long, right? People are longing the market. What's interesting here is that we see this spike in longs. And this is particularly in October 18th. At the same time, price actually comes down. So this is an indication that sometimes trading with the majority is not always the best idea. But generally, right, prices were in this uptrend, right? It's a general uptrend. We're seeing higher highs up until about early November, where we reached that 69K, and then from there we have slowly descended into the 40K range. During this particular time, the majority of future positions were long, as we can see here, right? The vast majority was above the 0% level, indicating that most people were long. As prices started to come down, we have seen an increase in shorts, but generally fairly neutral, right? Particularly throughout December into early January. Late January, we do see a particular notable increase in short positions, and this was during the time that we actually reached about 33K. We saw this buildup of shorts. People were expecting price to continue to come back down. Price actually retraced back up to, let's say, about 45K, and has been within this range for the past 2-3 months, give or take. And as a result, we kind of see that in the funding rate as well, where there's a general neutrality in the market. The market isn't necessarily, the futures market isn't necessarily giving us a direction that, or a bias that that traders want it to go towards, as we saw here, where there's overwhelmingly a noticeable amount of people longing the market. There's a noticeable amount of people here shorting the market. There is somewhat of a noticeable amount here, noticeable in late, or I should say mid-March of 2022. But at the same time, we are seeing the market sort of climb up. So once again, this could be an indication that you don't necessarily want to follow the herd in regards to what market sentiment looks like, and what other traders are doing. Just because everyone else is long doesn't necessarily mean that's the best move. And the same thing here, right? Just because everyone here was short doesn't necessarily mean that that's an indication that prices will continue to go down, and requires a bit more analysis than that. Here's an example of differences between the index price and futures price. Futures price, if the futures price is higher than index price, is an indication that more traders hold long positions. Funding payment paid from long position to short position. And if the index price is greater than the futures price, this is an indication that more traders hold short positions, and the funding payment is paid from short positions to long positions. Here's an example from Binance. This is how funding rates are calculated. They use this particular formula, nominal values of position multiplied by funding rate, and that's equal to the funding amount. And a nominal value of positions is equal to the mark price multiplied by the size of a contract. So this is something to keep in mind. Each of these exchanges may offer different stipulations and different ways of calculating funding rates. On Binance, funding rates occur every 8 hours at 0000 UTC, 8 o'clock UTC, and 16 hours UTC for all Binance Futures perpetual contracts. Here's an example of the exchange. This is the Binance Futures section on Binance. Binance is actually the world's most well-used exchange. Crypto exchange is the most popular one. It sees the highest volume by far. Coinbase is about the second largest in terms of volume, but Binance is a clear winner in that regards in terms of volume. The international community does use Binance quite a bit, and noticeably for futures markets. So this is something to keep in mind of if you want to just kind of keep a track of what the general consensus of where the market is going and what people are thinking in terms of their expectations of the market going up or the market going down. Here's an example of a Bitcoin perpetual contract. Let's say that Bitcoin to US dollar perpetual contracts are worth $1 of a Bitcoin. Now, if the market price of Bitcoin is $10,000, let's just say 10,000, you can open a position of 10,000 contracts to trade the equivalent of one Bitcoin. Each contract is worth $1, right? And if Bitcoin is worth $10,000, you can open up 10,000 contracts to trade the equivalent of one Bitcoin. Now, if you think the price of Bitcoin will go up, you'll go long. And you can hold that position as long as you want until you're satisfied with the price. Now, this could be hours, this could be days, this could be weeks, could be even months. Once again, this is a perpetual contract. There is no expiration date. Now, when you choose to close the position, the exchange will pay you the difference between the contract entry price and the current market price. That comes from another trader that chose to short and lost money. The only fees you must consider are the funding rate payment and any additional exchange fees.